Okay, now we're going from what I referred to as the big picture of the environment to what are we trying to do here in the Outbound course, and how does that relate to what you've studied last time, and also a little bit about the next course, which is in the spring. Now, from the standpoint of outbound from the US, the foreign countries where a US investor goes to do business, to them it's inbound. And you've already studied effectively connected income. You've already studied withholding taxes. Remember any of what you studied? Not really. Okay, well, we will on occasion bring up some of those things. From the standpoint of this course, please bring up anything because it's all related. You studied the source rules, right? Now, again, because I'm not asking you to memorize, the question is, if you were to need to find the source of a particular item, would you know where to look? Probably. Okay, that's 2/3 of the way there. Okay, anyway, the point is that when a U.S. investor is doing something overseas, what they are going to face in that other country is exactly what you studied last term, last quarter. Let's go back to our picture here. Let's say that in this, let's make this a corporation rather than an individual up here. And let's say that this is in a high tax country. These are both in other countries. High tax country, this one is in a low tax country. Let's say that the tax rate in this country is 45%. Tax rate in this country is 10%. And this one up here, remember, is preparing financial statements. He wants to have the lowest effective tax rate as possible in his financial statements. So if he has earnings in a country which is higher than the US rate, that means that he's going to have to show a higher than 35% effective tax rate in his financial statements for that income, unless he can find some way to effectively average these two. Unless he can somehow bring all of this income into one pot so that the average rate between the two now comes down to lower than 35, or let's say 35 or less. He's going to, if he cannot do that, then he's going to have to accept a high effective tax rate in his financial statements. That's a terrible result. Terrible. So part of this big picture of what we're going to do in this quarter is to say, how are companies either allowed or not allowed to do this? This sort of cross-crediting is the expression I used in the slide. And then secondly, how do we minimize what will be called, let's say, double taxation, where the same item of income is taxed by two governments at a, obviously, higher rate. So this situation of how do we mix And how do we avoid double taxation, which primarily means for the United States the foreign tax credit? That's going to be a good part of the next several weeks that we're looking at, in this case, the foreign tax credit. Now, the other major concern from the standpoint of the outbound course is what we'll call deferral. As we talked about Cisco or Google or the drug companies, they are attempting to maximize the ability to defer U.S. tax on earnings that they make outside the United States. They're trying to maximize what those earnings are and, of course, to defer U.S. tax as long as possible. As a practical matter, they're hoping to do it forever, which is why the accounting rules allow them to not accrue taxes for what they will pay in the future when they bring the money home. So this is going to be a big part of what we're doing. And because of this issue, Congress over the years has created the Subpart F rules for CFCs, controlled foreign corporations, the passive foreign investment company rules, transfer pricing rules, and non-recognition transaction rules, which involves let's say, transferring ownership of assets in some fashion outside the United States on a tax-free basis. So these two major areas, cross-crediting, double taxation focused at foreign tax credit, and then secondly, deferral focused at these other areas. So we will cover all of these areas to some extent within the course. A third area which I don't know whether we will get to in terms of lecture, but which again is sort of a major area which is always in the background, is that when things are done outside the United States, they're done in the currencies normally of the countries where the operations are. Well, are exchange rates, pretty constant? Well, maybe they were back in the 30s and 40s and 50s or something like that, but today they're not. There's a great amount of movement in exchange rates. And as a result, how you move from the environment in which the actual operations are taking place in some currency and then bringing them into a U.S. tax return, which is in U.S. dollars, makes a big difference. Now, we won't get into this in the course, but for me personally, one of the most interesting areas was being in hyperinflationary economies in several countries. The Russian ruble went from roughly, I think it was 50 or 60 or 70 to the dollar when I got to Moscow in 1992 to, I don't know, what was it, 8,000 when I left. Now, that's part of your environment. And if the local tax law is calculated in ruble terms, but economically the ruble doesn't mean very much because everybody is measuring things in this case, U.S. dollars back then, well, that's part of that matrix-type construct. You've got to reorient your thinking. So to me, that was absolutely fascinating. And all of the knowledge from working in that, when I got to Turkey, which was another country where there was hyperinflation, you know, it was like coming home. Anyway, so this area is another one I will put together eventually, and maybe this is a good time to mention it. The slides that I'm putting together are meant to be for you a reference tool to help you find things. I will normally, where I can, this slide didn't make it, but for example, if I'm talking about something in foreign currency, I'll indicate on the slide that it's 985 or 986 or whatever it happens to be for the particular thing. So use them as reference tools. I'll eventually get it up on the website. It's not anywhere near done yet. But I'll do this for each of the areas. So there will be a set of slides for foreign tax credit, which you've already got on the website. I may occasionally add things to it, in which case you'll get a new version. There will be a set of slides for Subpart F, for the PFIC rules, passive foreign investment companies, for transfer pricing, and for foreign currency. I don't remember. I might also put up one for dealing with tax treaties, but I'll see how much time I have.